Hey everybody, Signet here with the Bullish Bears. I'm going to do a shortened video. This is going to be a not quite a golden nugget, which is normally one of our 5-minute videos, but it's not going to be a full in-depth video. The reason I'm making this video is because I really got down into the weeds and I made a video on futures that covers almost every single aspect you could think of for the futures market. The problem is it's a really long video and a lot of people just want a quick introduction. And so this video is going to take the place of that. If you're looking for kind of just a handshake introduction to futures, this is going to be the video for you. If you do want to see that more in-depth video, I will be sticking that video link in the description. You'll be able to just follow that over and watch the more in-depth video. So introduction to futures. We're not trading futures options, we're trading futures contracts. It's still an obligation. You're still going to be obligated to do something. There's no backing out of it. If you sell it or buy it, you're on the hook. Okay? So just like with all trading in the marketplace, you're under contract and you're agreeing to do something. What is that something? With futures, that something could be that you're agreeing to take possession of coffee, lean hogs, corn, soy, or you may be contracting yourself to provide oil, soy, corn. Now, most brokers won't actually let the trade get that far. They will shut the trade down before expiration and keep you from getting caught up in that kind of situation. They'll dissolve your trade. Futures do expire, and they use this strange naming system. If we go in on Thinkorswim and we go to the ES, the S&P 500 mini futures, you can see that right now we're trading on a particular contract. We're on the H, and this is 2020, so this is H20. Last year, in January and February and March, it was H19. When we're done with the March contracts or the February contracts, we'll be in the ESM and then the U and then the Z. And you can see that next year's contracts, a year away, they are ESH21. Okay, so between now and the end of March, March 21, we can trade the ES contract using ESH. Now, when it gets very close to expiration, you're going to notice that the liquidity in this contract really starts to back off. Well, what do I mean by that? Look over here where we've got volume. We've got over 1 million contracts being traded just today in the ESH series. And you can see that it is the active one right here. Below that is the ESM, which expires in June, and it is being traded. There are over 3,900 contracts just today that have been traded on the ESM. When it gets close to expiration, this ESH is going to lose volume. You won't see a lot of people trading it because it is too close to expiration. And instead, they'll begin trading the ESM a lot more. On Thinkorswim, you don't have to keep track of that at all. It will automatically update you on whatever contract is the most liquid or popular at the time. And so all you need to do is just type in that you want to look at the NASDAQ, the ES, whatever it is, and it will go to the one you want. Notice here, even though it's not telling me which one I'm trading in this drop down, it does show that I'm on the H contract and it will expire in March. Okay, so I don't need to stress on that. I don't have to worry about it. It's right there. Most brokers will close your trade if you're trying to swing these and stop you from having to provide a truck of coffee to somebody or perhaps take possession of a truck full of lean hogs. All right, so that handles agreements with obligations. When it comes to trading futures, you really need to know your market. Okay? Not all futures open at the same time, and not all futures close at the same time. Now, most of us who day trade at the bullish bears, we're focused on equity futures, the NASDAQ, the S&P, the Russell, the Dow. That doesn't mean that you can't trade other products. It just means that you need to be able to know how to find that information. When does your market open and when does your market close? If we go to oil, for an example, when does oil close? When does it open? And is there a certain time that I need to pay attention to? Thinkorswim darkens the chart for us between Globex and regular trading hours. This yellow line is an indicator that is designed to let me know when the market opens back up in the Globex. You can see that oil opens up at 6 o'clock p.m. That's 1800. The market closed at 1430. This in the middle is not traded by retailers. If we go over to ES, you are a retail trader, I'm a retail trader. That's what I mean by retailers. Here is the S&P, and you can see Globex opened at 6 o'clock, 1800. The market closed at 4:15, and between 4:15 and 6 o'clock, we don't trade this product. But any other time we can. So for 22 hours a day, we can trade futures products. You need to know when it's open. You need to know when it's closing. You need to know how to find that information out. I just use the indicator, but you can go to websites. If you Google what time does oil open, you'll find out. What time does oil close? When does the corn futures close? When does soy futures close? I'm not interested in trading those, so I've never gone to look at when they open or when they close. But if you wanted to trade those, you would want to just take the time to go learn when that is. It's that simple. We don't need to memorize every single market out there and know when all of them open and know when all of them close. Now, no matter what futures contract you want to trade, you really want to know when the S&P opens and closes. We'll get into that later on. So know your market. When does it open? When does it close? Know how to find out. What's the point of trading futures? Probably to make money, right? But really, what's the point? I mean, I could trade SPY. Why would I trade the S&P 500 futures? If I've got a retirement account, for an example, and I've got a lot of shares of stock in Microsoft and Facebook and Amazon and Yahoo or whatever, and the market starts to go down, I could sell an S&P 500 futures contract to hedge my portfolio, meaning I would be making money when the S&P fell in my futures contract while I'm losing money as the S&P falls in all of my trades that are like Facebook and Amazon and Microsoft. That way I could protect my portfolio from a drawdown, making money short while the market is short. And then when the market turns around and starts going back up again, I can also trade it back to the upside, having protected my portfolio. Hedge trading is one way that people use futures. The other way is with speculation. Speculation is more of, can I just make money in this? And yes, you absolutely can. So if you're looking to grow an account or pay your bills, maybe be an at-home trader, this would be the market you would absolutely want to focus on. Why try to struggle day trading options which were never designed to be day traded? Why struggle with Friday expiration options which were never designed to be traded Friday to Friday? When you could go in here and with a lot less risk and a lot less time, you could easily hit your daily goals and live on your winnings. So speculation, account growth, and account protection is really the point of trading futures. Futures are outside the boundaries of PDT. You might have heard me say that a few minutes ago. We trade them 22 hours a day with no PDT. And the reason for that is because the government that monitors futures is a different government that monitors the rest of the marketplace. This has the NFA and the CFTC, the Commodity and Futures Trading Commission, and the National Futures Association. You can geek out on that if you want to. I'm going to leave that for you to follow up on your own. You at least now can write them down and go Google them and dig deeper into it. That is not the focus of this video, so I'm just going to leave it be. Edge. So when it comes to trading futures, we do have edge in this. We do not have edge in trying to trade shares of stock or options on a day-to-day basis. The account size that you need to be able to trade something like Tesla or Amazon with shares, you would need a really large account. And you've got to put that capital up. And yet, if you want to make a lot of money, you could trade the ES with contracts and you wouldn't have to put up even a quarter of the size at risk. Okay, so without PDT, you can get in and out of the market all day long, all night long, and you don't have to worry about PDT. There's a lot of edge in that. Say you've got a pretty good size account and you want to day trade, but you don't quite meet the requirements of that $25,000 standard that the government has put in place. Well, that's a big restriction on your ability to be able to stay home and trade. Not anymore. Because now you can just leave that completely to a different marketplace and you could trade futures. There is massive leverage in trading futures. When the ES moves 1 point, you could make or lose $50. $50. Look at how much the S&P moved in one swing of the market high and low. Just one swing right there. And that was in 25 minutes, just 6 bars, it moved almost 9 points. 1 point was $50. 10 points, you're day done, right? You're well along and you don't have to worry about trading for the rest of the day. Just like that. All right, so being able to get day done in a market is very easy when it's a leveraged product. The idea would be, which product do you want to trade and how much leverage will you get trading that one particular product? I did mention this, we'll say it again. Futures are open 22 hours a day. There's a very small window that you are not allowed to trade. Maybe if you go and get special permissions, but really, do you need it? Out of the whole day that you could trade 22 hours a day, do you really need that one small window where you're not allowed to trade? So between 4:15 and 6 o'clock, you're done. That's it. Any other time other than that, you've got the world as your oyster. You could run out and trade all you want. So really, that's not too bad at all, right? Just that small little window. It's minimal costs to trade futures. Now you can see the initial margin requirements. If we hit the drop down tab here and we go to futures, you can see the S&P for initial margin $7,260. The requirements to day trade would be 1/4 of that size. So if you wanted to day trade the S&P 500 futures contract, you would need $1,800 per contract. That's not too bad. There are brokers out there who will let you trade it for less buying power than that. And we'll get to that later on, and we've covered that extensively in other videos. If you hold a futures contract into the close, the margin requirement here goes back to this original margin requirement here. So be very careful to always exit your trades before the close unless you can cover the initial margin value per contract. Otherwise, they will liquidate your position whether you were winning or losing. They'll charge you a fee for liquidating your trade, and then you're stuck. So get out before the close or make sure you have enough money to hold through the close. I say minimal costs. This margin here is not something that you actually have to pay. All you're doing is leasing or borrowing that contract. You're bringing it back. You don't want to keep it, right? So if you go to the beach and you want to take a jet ski for the day, maybe they charge you $25 an hour, but they say, I'm not quite for sure that you're going to bring my jet ski back. So you need to give me a deposit. So you give them $7,260 and you take the jet ski for a ride all day. And when you bring it back with gas in it, you get the $7,260 back, and then you pay them for the privilege, right? It's the same with futures contracts. This is the margin, but you're not actually buying that contract. You're just borrowing it. So think of the margin as the buying power reduction. The minimal cost that I spoke of is your commissions and the fees. Now, I don't trade on Thinkorswim, but we're going to go in here and get the pop-up if I was trying to buy it. So we just hit this, tell it I want to buy one contract. It's the MAR 20 futures contract. We hit confirm and send, and now we can see that this trade would cost me $2.25 in commissions and $1.25 in fees, and that would be $3.50 to get into the trade, another $3.50 to get out. So round trip to trade this futures contract on Thinkorswim, it's going to cost me $7. Well, that's not bad. That's minimal costs. Again, there could be brokers with better margin, commissions and fees and all of that. Maybe if you trade enough, you can negotiate a lower value. Something to look into for the broker that you use. When it comes to trading futures, we've got a variety of things that we can trade. Now, most retail traders really only focus on the S&P, the NASDAQ, the volatility futures, and oil. I have not yet run across anybody who's trading agricultural products. And that's not to say you can't, I just don't know anybody who does. Trading the interest rates would be something I'm really interested in doing. I just haven't done it. The precious metals, there are a few people in the Bullish Bears community who have been trading gold and silver. I have not talked to them about their success with it, but I don't think they would continue doing it if they hadn't been successful. Metals, interest rates, energy, FX currency, the equity indexes, which is what I've been talking about, the NASDAQ, the S&P, agricultural products, and volatility. So why bother with futures at all? Even if you never intend to ever even trade a futures contract and you're just going to day trade penny stocks, you would really want to understand the effect of the futures market on the marketplace. The marketplace sometimes pushes the futures around, but a lot of times the futures push the marketplace around. So understanding what's going on in the S&P today is going to make a big difference in understanding what you're trading today. Right? So that's why it's important to understand the futures market, even if you don't want to trade the futures market. Another thing is futures actually impact the order flow in the marketplace. The S&P is like the granddaddy of the market. It's the big one, right? And when it comes to seeing the S&P move around in the marketplace, it drives order flow throughout the market. If you watch the S&P and you go and watch something like Apple, for an example, you'll notice that they're highly correlated, just like the NASDAQ and Apple are highly correlated. So when the futures market moves around, it drives the order flow in the market. There are algorithms out there that are synced to trade the baskets of stocks in these equity futures products. And you can go in and you can look in the marketplace and just kind of ask the question, what products are in the S&P? Well, here's the S&P 100. You can see the list of them down here. When the S&P is moving, these products are affected. Okay? So keeping track of the futures, this is why, even if you don't want to trade futures. When it comes to trading futures, a lot of people have told me, no, I'm not really interested in that. You know, I've spent a lot of time learning price action or options or shares. I want to do this kind of trading, and I don't want to have to go out and learn something new, and it just seems really complex. Futures are like raw price action. It doesn't get any more raw in trading than that. And if you've day traded anything, you've been building the muscle skills, you've been working out your muscles with an ability to day trade anything. Futures are the easiest thing to trade. If you've day traded a penny stock, then you could easily day trade this. All right. What holds people back is the language. You've heard me say it's a leveraged product. It trades in ticks and it has tick values, and then there's tick sizes. That throws people off. It makes them not want to trade it because they don't understand what that means. Once you have a grasp of that simple concept, you're really good to go. The idea is knowing where to get that information. So where do you get that information? On Thinkorswim, you can just click the drop-down menu and choose futures. This is a regular. When you drop down, you would normally go to something like SPY. And when you drop down, it shows you this. Now you just go to futures, and we could look for the ES. And there's the ES tick size and tick value, and then the initial margin. So now I could find the tick size on any product that I want to trade. I could just let Thinkorswim tell me what that tick size is. So when it comes to futures, there's notional value, tick size, tick value, margin, points, handles. It sounds like a lot of different things to learn. But if you think about it, every single product in the marketplace has a tick value. Facebook, Microsoft, Amazon, Google, they all have tick values. The difference is all those products have a 1 penny tick, meaning when the market moves up, it moves up by a penny. 1 penny at a time, 1 penny, 1 penny, 1 penny, 1 penny. Now, it could gap, it could run. It can't move smaller than 1 penny at a time. That's the tick value. Those OCOs that you see, those mini markets, you could find them at hundredths of a penny. Their tick values are going to be different. But most products have a penny tick. Then you get into futures, and futures have their own tick. Some of them share the same tick size. Some of them use fractal dissemination. So you got to know what the tick size is. The equity products, the S&P 500 and the NASDAQ, they have a 25-cent tick size. And that means if we zoom in as small as we could get, we can't find that the S&P moved anywhere smaller than 1/4. 33425, 334275. It didn't stop along the way. It didn't stop at 334255 or 57 or 62. It went all the way up to the next quarter size. That's 1 tick. Now, if I was to zoom in on Facebook, we would see that it would go 1 penny and then another penny and then another penny because it has a penny tick. So the S&P doesn't move in pennies, it moves in quarters. Those quarters are called ticks. In the NASDAQ, it also never moves penny to penny to penny. It only moves tick to tick to tick, 1/4 at a time. If we zoom in, you can see we go from 75 cents to a round dollar, 25 cents, 50 cents, 75 cents, another round dollar. It will never stop somewhere in the middle. Okay, and that's a tick. Well, that's easy, right? There's nothing to that. That is very simple. So what's a point? If I go from 94.30 to 94.31, that's 1 point. Now, why do we need to call it a point? Why can't we just say that the NASDAQ moved $1 from 94.30 to 94.35? The reason we can't say, well, the NASDAQ moved $1 is how do we discuss a trade? If I tell you, hey, I traded the NASDAQ today, I took a trade $3, you're going to laugh and say, am I supposed to be excited about that? Well, you took a trade and you made $3. Yay. But the NASDAQ makes or loses $20 in a $1 move because there's 4 ticks in a dollar. So if I say, hey, I took a trade on the NASDAQ today and I made 3 ticks, or excuse me, I made 3 points, then you could say, oh, you made a $60 trade today. Well, that's not bad, I guess, right? That's not bad. Nice little scalp. Yeah, I traded it for 3 points. That's why we need to use that word instead of saying, oh, yeah, I took a trade in the NASDAQ. I made $3. I made a $3 trade in the NASDAQ. So we just have to distinguish between what it is that we're talking about. Did I get in a trade with a 3-point move? Or did I get in a trade and only make $3? And that's why we call it points. So there are 4 ticks in a point because when you have a $1 point and ticks are 25 cents, well, there's 4 quarters in a dollar. So 4 ticks, that's a point. A handle is also a point. So if you hear somebody say handles or you hear somebody say points, it's the same difference. I have heard somebody refer to a handle as a 100-point move. I only heard that from one person. I've never heard it anywhere else. I don't think I quite agree with it. Either way, you now have that one as well. So points, handles, tick value, tick size. We've got notional value. So you can see here I discussed the S&P. It was 25-cent tick size, 4 ticks in a dollar. Same with the NASDAQ. Oil has a 1 penny tick, just like Facebook or Amazon or Microsoft. The difference is how much money is made or lost per tick. So when you have tick size, you also have tick value. The tick value is really important to know and to understand. You don't have to memorize every tick value out there. You just need to know, where do I find it? So let's go find the tick values for these 3 products. We've got the NASDAQ, the S&P, the oil, and we'll even do bonds. So we'll just start with the S&P. Come up here, we'll go to the ES, we hit futures. The tick value is $12.50. We need to do the same thing for the NASDAQ. Right here, you can see it's $5 tick value. We need oil. So we go in there, $10. And we need bonds. And just like that, $31.25. So what this is showing us is every time the S&P moves 1 tick, you make or lose $12.50. Every time the NASDAQ moves one tick, you make or lose $5. Every time oil moves 1 penny, you make or lose $10. And bonds, well, they use fractal dissemination. And I'll zoom in here so you can see what that looks like. 161 is the round number. From there, it's got a fractal 1 over 32, 2 over 32, 3 over 32, and it keeps going in that size all the way up to 31. When it gets to 32, it just becomes a whole new number again. We were looking at 161. Here's 162. There's 32 ticks in the middle of this. So that's the only one that's different out of the ones that we've talked about so far. There are other products that use fractal dissemination, but more and more that's getting weeded out. The whole futures market used to work that way. Could you imagine trading fractal dissemination on everything? That would just be really bothersome. Thankfully, we don't have to trade that way anymore. So if there are 32 ticks and each tick is worth $31.25, then 1 point is worth $1,000. That's a lot of money. Oil is the same way. Oil would be $1,000 in a 1 point move. NASDAQ, $20 in a 1 point move. And the S&P, $50 in a 1 point move. We'll just highlight that for the video. And that way, I know that we've got it covered. So now hopefully you can begin to see why we want to trade something that looks like this and not something that looks like a penny stock. And we can do it all day long with no PDT. But you have to know your market. All right, so the next thing that we have to cover is notional value. Really, the idea of notional value is more about understanding the actual leverage that you've just grabbed a hold of. For an example, in the NASDAQ, I threw together just a real quick notional value based on the spot price. And the spot price is, quote, the right now price. So when the NASDAQ was at 94.37, it had a notional value of $188,000. Yeah, that's a pretty large market. All right. So when you see the NASDAQ moving, or you see the S&P moving, or the oil or futures, you got to understand that, sure, it might be showing, 94.37, but what's the notional value of that thing? When you're going to go in there and you're going to trade with one contract at a 1 point move in the NASDAQ, what's the notional value of that? It's freaking huge. That's what it is. So the way that you calculate that is you take the spot price, the right now price, and you multiply it by the point size. Okay, remember the point size in the S&P. We come up here and we get the tick value, and the tick here, the 1 point tick in the NASDAQ is $20. In the S&P, it's $50. So if we wanted to do the S&P, we could take the spot price, $33.44, and multiply it by 50. We'll just do that here. $167,000 is the notional value of the S&P right now. That's a lot of money. And just understanding this, that is going to help you grasp the gravity of the situation. And it'll help you grasp that when you see the S&Ps moving, that there is a lot of money behind that. It is pressure on the marketplace, or that there is so much pressure from the marketplace that it's moving this product. So let's talk about that a little bit. The S&P has an unspoken understanding. The understanding is that the S&P is the most powerful market out there. You really need to know what that market is doing. Where did it open? Where is it going today? The S&P is critical no matter what you want to trade, no matter how you want to trade it. You need to understand this fact, this un, unspoken fact. It's critical no matter what else you want to do, no matter what else how you want to trade it. You need to know this. The S&P absolutely is the most powerful thing out there. If it's having a bad day, so is everything else. Right? If it's having a good day, then almost everything else is having a good day. If it doesn't, it's probably because it has its own catalyst. The S&P is where all of the options are priced from. Without the S&P, we wouldn't have the VIX calculation, and VIX is derived from the S&P. The volatility is the calculation that we use in all of the options marketplace. It's all derived from the VIX. So it is critical to understand what is going on in the S&P, not just because of its monetary value, but because it affects everything, including the options market, including the VIX. That's why it's just so critical. So we talked about margin a little bit. Margin is one of those words that can mean a lot of different things. If you have traded shares of stock or maybe options, you might have had a broker offer you margin. They're offering to loan you money or let you trade with borrow money. That's margin. But there's also another kind of margin, and there is also span margin, standard portfolio analysis of system risk. Yeah, ain't that a mouthful? I have a term for it that I don't want to use because this is a public video and I don't want to offend anybody, but it's called the OS, right? The darn formula. What that formula is this. This number here is calculated based on a situational simulation. What is the worst that could happen today in the marketplace, and that's how it prices. Okay, so they take the what if scenario of the market, and if you were holding one contract of lean hog futures in a worst case scenario, what would be your risk? And that's what they want in margin, in buying power. So that standard margin, that span margin, most brokers use that. Any broker that you could think of off the top of your head is probably going to use that. But there are a few brokers who do not use that. And they are the ones that we usually invite small account people to. You know, like if you're trading with $1,000, you would want to go to a small account broker, not one of the brokers that uses span margin. And then there's your intraday margin. So once you've got your initial margin and you know that copper futures require almost $3,000 per contract for your initial margin, we can divide that by 4, and that would be our day trade margin. So if you wanted to day trade copper futures, you would need 1/4 the size of this, 2,970 just divided by 4. That would be how much buying power reduction you would need per contract. That's your day trading margin per contract versus the initial margin, or the margin that you would need if it goes into the close. So if I traded lean hog futures and I held on to it into the close, sure, I might have been able to trade it for $700 a piece, or $7,300 a piece. Excuse me, $730 something a piece. When it goes into the close, I'm going to need to carry $2,420 for every one of those contracts, or they're going to liquidate me. Okay, so margin is something that we cover in depth in the other videos. Just needed to bring it up as a part of this quick video, which is not so quick. We've already passed the 40-minute mark. And then expiration. We covered that earlier. We're just going to let that go. Recognize that there are 3 ways that you can deal with contracts. You can take the cash if you're trading something like the VIX or the S&P. It's not like you can deliver volatility to somebody, right? You can't take delivery of volatility from somebody. If I'm trading the S&P and I hold it all the way to expiration, somebody can't come to me and demand the S&P. It's a cash settlement product. If I'm trading coffee, that's a completely different story, right? But again, your broker would more than likely close your trade and you would not have to go give somebody coffee. But you can take the cash, you can roll the contract, or you can just close the trade. You don't need to hang on to these all the way to expiration. All right, and I've been showing this on thinkorswim the whole time, so I'm not going to go in and demonstrate it more now, since I've been doing this interactively. The last time I made the video, or in the bigger video, I used a bunch of slides, and we really drilled down into all of these topics in detail. All right, so you now have the quick version of futures.